Let's start with the basics. What's a credit score? It's a 3-digit number typically between 300 and 850, designed to represent your credit risk or the likelihood you will pay your bills on time. Basically, a higher credit score means anybody lending you money can trust that you'll pay that money back on time. Credit scores are calculated using information from your credit reports, including your payment history, the amount of debt you have, and the length of your credit history. Higher scores mean you have demonstrated responsible credit behavior in the past, which may make potential lenders and creditors more confident when evaluating a credit request. Here's a general look at credit score ranges. Keep in mind each credit scoring model is slightly different. Credit scores may vary according to the scoring model used and may vary based on which credit bureau furnishes the credit report used for the data. That's because not all creditors report to all 3 nationwide credit bureaus, Equifax, Experian, and TransUnion. Some may report to only 2, 1, or none at all. In addition, lenders may also use a blended credit score from the 3 major credit bureaus. This is great and all, right? But why is that score so important? Great question. The answer is super important to understand. Higher credit scores generally result in more favorable credit terms. This is why it's so tied to your personal capital structure and overall financial freedom. A higher credit score allows you to take on debt with lower interest rates. It allows you the freedom of taking out $30,000 at a 2% interest rate instead of a 15% interest rate. That's a difference between $600 in interest and $4,500 in interest. For example, let's say that you and a friend both need a $30,000 loan for a car. You have a credit score of 750, and your friend's score is 550. You might both receive the loan, but because your score is higher, you'll likely receive the loan at a lower rate, which means you'll pay less interest each month. Using the example above, it could be the difference between paying $600 in interest or $4,500 in interest. While you might think, yeah, that sounds like great savings, the point is that whenever you have a good credit score, you're reducing your interest rates, and that's crucial in terms of building long-term wealth. When you do that, you free up more of your money for other things, such as investing in yourself through investment accounts, building your emergency funds, and building wealth. If you have an extra $100 or even $50 a month, you can invest that in the right stocks, which will teach you exactly how to do. And with that minimal investment, you can grow your wealth from hundreds to hundreds of thousands in 5 to 10 years. More on that later.